Whenever I get a call about a stock that I'm stumped by, I take the time to do the homework, then come back to you with a more considered opinion rather than just cuff it. So let's catch up on our summer reading. On April 1st, Dave in Arizona asked me about CareDx. That's cDNA for you home gamers. I said I'd get back to him. This is a diagnostics company. You know we like those. It's focused on helping transplant patients. They help doctors find a better match between donated organs and the recipients. And they help monitor patients for early signs that your body might be rejecting the transplant. Now, there's a definite need for this stuff, so you can understand why CareDx has been such a smoking hot stock. 2 years ago, this was a penny stock, though. It's now at just under $40, meaning it's rallied more than 2,300%. You can't make money in this market, 2,300%. That's an incredible move. And it includes a 212% run in just the past 12 months. As much as I hate to chase stocks that have moved up so dramatically, the fact is CareDx deserves these gains. 2 years ago, they didn't have any products on the market. Now they have two diagnostic tools, one for pre-transplant organ matching, one for post-transplant monitoring. And they've both been very successful. Last month, management gave multiple industry presentations where they sounded confident about the company's momentum. That's why CareDx has been able to report a series of better-than-expected quarters. And as a result, the analysts have been scrambling to raise their estimates. And this is what you get. Even after its epic run, when you look at the forecast for out years, say 2021, the stock, which is how you value these growth stocks, stocks trading at less than 22 times earnings. Average stock trades at 19. This is so no average stock. So it's not all that expensive. Although if you look at next year, it's selling for 67 times earnings. So you're banking on some major growth in the next 2 years. Oh, and it doesn't hurt that the medical device cohort is beloved right now, because these are the kinds of companies that can thrive in a slowdown. And it's one part of the healthcare industry that doesn't seem to be under fire from most of the Democrats who are running for president. They've been unscathed. It's one of the reasons, by the way, that I really like Abbott Labs, and you know I like Medtronic. So where do I come down on this one? Well, it's no Abiomed. I like CareDx, and I wish I'd recommended it when Dave called, back when it was trading in the low 30s. Like many of our viewers, Dave's got horse sense. But at just under 40 bucks, I'm sorry, you got to wait for a pullback, although it probably won't last long. The stock dipped from 40 to 35 last week and already erased most of that decline. That's why you have my blessing to put on a small speculative position right here. Obviously, speculation. Be careful. That's what we learned from Abiomed. Next up on April 10th, Dave in Ohio called about Orbcomm. This is ORBC. And I said I needed to do some homework, didn't do some research, before chiming in with a more considered opinion. Orbcomm is a machine communications company that's all about the industrial Internet of Things. We love the IoT. It's a great theme, and we bet a lot of money betting on stocks that are in it. Basically, they track, monitor, control, and enhance security for everything from trucks to rail cars to sea containers to power generators, fluid tanks, oil wells, irrigation control systems, heavy equipment, you name it. Now, Orbcomm stock has been a real laggard, and you can see that. It was a laggard for a while, right up until the past couple of months. In fact, Dave in Ohio nearly called the bottom right here. Since then, the stock's up 20%. Nice. Why has this one been breaking out here? Look, I get the appeal of the business. They help companies keep track of their ever-growing fleets of logistic assets and machinery, kind of, again, a bit of a thing like we saw from WEX last night. But its end markets are pretty cyclical. So if you're worried about a worldwide slowdown, as Jay Powell, the Fed chief, clearly is, this may not be the best place to invest. Stock's currently just over $8. It wouldn't be surprised me if it got to $9 just on the strength of the current momentum. However, Orbcomm has a spotty operational record, and it sure doesn't help that the company is not yet profitable. Plus, when you get your head around what these guys do, I mean, they're in a very similar business to a company that we've talked to about many times that I really like, and that's called Zebra Technologies. And I simply can't think of a reason to buy Orbcomm over the much better run Zebra. Think barcode. If you like Orbcomm, you will love Zebra Technologies, even after that last quarter, which wasn't so hot. And its added advantage of, well, Zebra's extremely profitable. This is a case where you want to stick with the best of breed. Finally, on April 30th, Jeff in Kentucky called about one that I've had to make a lot of calls on because it's really pretty cool. And I didn't know it, and that was my bad that I did. It's called Elastic. And we got not only one question, we also got a question May 10th about this one from Fernando in New York. I mean, why do I know this one? It's a Dutch company, okay? A Dutch company. It's a software company with technology that helped us research. See, this is big move and then not doing much, but it helps research large quantities of both structured and unstructured data. Now, you might not be familiar with the name, but you probably have used Elastic's platform. See, when you use Uber, well, that's Elastic software. It's how powers the systems that locate nearby drivers. When you look for a match on Tinder, the online dating platform, Elastic helps power the algorithms that make it happen. Now, I don't know anything about Tinder. I used to think it was something that started fires, but people tell me it's a very big deal. I'm no Boy Scout, but I still don't get it. Elastic came public early last October with the deal pricing at $36. Stock immediately surging up to $70 at the open because there was so much demand. But because of a big fourth quarter meltdown, it pulled back to $58. Now, it doesn't look as bad as it is, but people are saying be careful of the stock because of the chart. Oh, please, come on. While the stock then roared to 100 in February ahead of earnings, when Elastic actually reported the numbers were good, but not good enough to justify moving the stock, the momentum guys didn't like it. Since then, the stock's been marking time in the 70s and 80s, although it's shown some signs of life in the last few weeks. In short, Elastic has been, well, an elastic trader. The weird thing is that Elastic's had trouble rallying, even in an environment where many newly public software stocks have been just red hot. I think part of the reason is that it's got slower growth. Now, don't get me wrong, slower growth is really a relative thing. This is growing at 47%. Last I looked, that was pretty good. But it compares to a company like Twilio. That also helps app developers, and Twilio is growing at a 70% clip, and people are just beginning to learn about it. Yet Elastic sells for nearly 12 times next year's sales, while Twilio sells for just over 10 times next year's sales. I know, remember, not earnings sales, so we're talking about nosebleed. Granted, there's some stocks like Slack or Zoom Video that have much higher, more ridiculous valuations, but that really doesn't justify paying too much for Elastic. While I am intrigued by Elastic, I'm also concerned that they're going to see a pullback in the highest-flying software-as-a-service stocks. Don't forget, while Elastic hasn't had much traction lately, this thing came public at 36 less than a year ago. It's now in the 80s. It's just that most of these gains came in the first minute of trading. Elastic is far from my favorite here, but if you really like it, I'm telling you to wait. I think you're going to get a better buying opportunity at lower prices. In Twilio, it's best in show. We own it for the charitable trust. I'd still buy it even up here as a starter position only, then hope it comes down, which it periodically does every so often, because even Cramer fave Jeff Lawson, the brilliant Twilio CEO, isn't perfect. But then again, as we know from Some Like It Hot, nobody is. Mad Money's back after the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.